Welcome to My Money Mindset podcast, where we explore how a healthy mindset is the foundation for financial success. Each week, we delve into mindset hacks and practical strategies to help you enhance your income, help you make more appropriate investments for yourself, and to improve your overall financial well-being. Join us on this journey to transform your financial future by transforming your mindset. Please note that the information provided on this podcast is for general information purposes only and does not constitute as personal, financial or health advice. It has been prepared without considering your individual objectives, financial situation or life needs. Before making any financial or health decisions, you should consult with a qualified professional or financial advisor to ensure the information aligns with your specific circumstances. So let's begin and enjoy this journey as each episode teaches us on how to improve our overall mindset that overall improves our financial success. Hello everyone and welcome to another episode of Money Mindset. Now today I wanted to talk about, obviously with a lot going on in the economy, how first home owners are actually going to get into the buying property. Obviously it's becoming harder and harder, and as the interest rates have just gone up so much in the past 2-3 years, they've actually placed a lot of people behind, and it's costing way too much, especially for first home owners that are looking to get into the market, so much. Now, what you guys may not be aware of in the background is that when finance brokers, when we actually go to put how much you can service for a loan, so for instance, if you're earning $50,000 per annum, there's two of you or only one of you, we add those combination of incomes in gross, so before tax. And then what happens is each bank has a different, what they call serviceability calculator. They assess on their terms how much you can borrow. So a lot of banks have different borrowing capacities, as in lending capacities, depending on your income. Some favor other incomes, other banks prefer other professionals, and then they waive certain fees and so on and so forth. So there's a massive array of different banks with different policies, which realistically, as brokers, we're meant to keep up on. And basically what happens is the bank provide us with these serviceability calculators, and we input your incomes. We also put in your assets and your liabilities, and then that calculator ends up giving us a result on how much you can borrow, so to speak, right? Now that's a simple way of putting it, and there's a lot more different information that's required. And as you go through with applying for a refinance or a purchase, pre-approval, that sort of stuff, this is what we sort of, as brokers, have to put into the serviceability calculator, also for finance mentors, right? So basically what the banks do, on average, most banks across the board use what they call a serviceability buffer. Now, that serviceability buffer is a buffer that actually is a percentage that's placed on top of the interest rate or current interest rate that bank is providing to potential borrowers today. So what does that mean? If the interest rate is at, let's call it 6%, for the average person that's wanting to buy a home loan, let's assume that it's an 80% borrow and it's at 6%, you put your income in, but they place a buffer on top of that 6%. Now that buffer amount is generally 3%. This is pretty much across the board with most banks. That 3% is added on top of the 6%, meaning that your serviceability is based on an interest rate of 9%, not the 6%. And this often throws a lot of people out, think, why are they doing that? Why are they actually assessing at 9%? And it's simply because they're actually factoring if there was an interest rate rise whilst the 30-year term of this loan. So normally your loan is provided over a 30-year term, generally, 25 to 30-year term. You can get shorter, but they base it on the 30-year term. And they say if there is an interest rate hike throughout that 30 years of owning the home loan in assumption, then they've sort of created a buffer of serviceability, right? So if the interest rate started to climb from 6% up to 7 to 8 to 9, then they've created that buffer. Now, the important thing here to remember is in some way it's there to protect the borrower more than the bank itself as well, because basically what the bank is sort of doing is they're saying, well, listen guys, we know that it's at 6%, the interest rate, but we need to place an additional pressure test of 3% on top of that to make it 9%. And in a way that protects the borrower as well as the bank, simply because they're basically saying, well, if there is an interest rate hike, we don't have a crystal ball, we're trying to protect you that if the interest rate was at 9%, these are the repayments that are required, you're still okay. And in a way, it's a bit of a safeguard for both the borrower and the bank, right? But it doesn't enable you to get your property, especially as a first-time owner. So the two hurdles in a first-time owner is, number one, a deposit, having enough deposit, dancing around what the government are now creating with incentives with the first-time owners grant, stamp duty. Quite often we find that with the home, there's quite a bit of arguments between, is the first-time owners grant worthy of it, because it sometimes, most of the time, it was originally just designed to provide a first-time owners grant to first-time owners for new or off-the-plan properties, meaning that the developer would just increase their prices on the property and absorb that extra 10,000 or whatever it was at the time with the first-time owners grant, right? So in some ways it does help, but it doesn't help if you're going to buy an established property in some states, right? So basically what they're saying is the deposit's needed and your serviceability levels needed. Now, 9 times out of 10, someone that's actually beginning out working in their 20s or early 30s, they're earning pretty good income, but they're also trying to increase their income, growing their careers, growing their business, all that sort of stuff. So trying to establish a really strong deposit is sometimes quite rare, but it does happen. Sometimes we get parents going as guarantees and so on and so forth. So that's another strategy. But all in all, for this episode, we're just talking about the serviceability buffer and why it is at 3%. So obviously the serviceability on your income is going to need to be greater. So institutions are now starting to pop up and say, well, instead of that 3% for first home owners, why don't we drop it down to 2.5%? So for the interest rate, actual interest rates at 6%, on the service on an interest for the loan, then why don't we do it on the serviceability calculators on average at 8.5%, not 9? Give it a bit more leeway towards the borrower. It decreases the amount that's required in order to service a loan at a certain amount, right? So as opposed to 3% buffer, make it 2.5. Now, that would actually enable people to borrow a little bit more and make their loan a little bit higher. Now, in one way, that's a good thing because it makes the property more affordable, or the property that you're actually going for, the affordability, a lot more affordable and a lot more chances across the board of getting that loan approved. So it is something that is on the cards at the moment. Watch this space. I think there's going to be a lot of movement in this area where the government have to actually start implementing such incentives and dropping down the regulations or harsh regulations in some instances, and start really picking out the more favourable tactics in order for first home owners to achieve a successful loan to buy the property that they're after, not so much governed upon if it's brand new or off the plan and have to wait and then buy land and then have to go through the construction rigmarole. You know, a lot of that is a lot of work for, and especially for new property investors or owners, that can become so over daunting that they basically wipe their hands of it, because it only takes one person, and that's for anyone, for one decline in their application of loan to throw them off the course. And it's quite hard as it is to make a living these days with the way the inflation has been, that the first home owners sort of really just don't get motivated when they can't get a loan, and they think it's all too hard, and it's, just having to rent and pay for bills and save and everything can become quite daunting. So I believe that the government have to create these small, particular differentiating tactics to be able, or in order for first home owners to be able to afford their property or properties. Is it so much about people trying to own as many properties as possible? Well, maybe yes, but maybe no. But what actually has to happen here is it has to enable, especially if we're getting more people populating within Australia, to be able to have housing affordability, having housing or the loans more achievable. So in other words, the only way you can afford housing or to buy your first property or properties is to make the loans more realistic. So going back to the serviceability buffer, as opposed to as an interest rate of 6% today, making it at 8.5 or 8%, something that's a little bit more achievable. Now, what a lot of people say, well, it's a good thing that the banks are putting a buffer rate at 3% because it protects the lender. Yes and no. What happens, what we've found is most loans, especially when they're set up for a 30-year term, people don't actually end up staying with that bank for 30 years. Statistics are saying that a lot of people start to refinance around a 5-year term. And thus what really good brokers do with their clients is they keep on them and make sure that they are always paying for the most cheapest rate whilst they do have their home loan. So the argument here is, well, yes, we know that the term is over 30 years, but we also understand that the borrowers are only staying in their home loan on average 4 to 5 years before they refinance to a cheaper product or another bank that is cheaper. And, that's only what people do. If the supermarket's offering cheaper prices, we all go to the cheaper supermarket. And that's basically what we have to do as brokers or finance mentors to protect our clients from overpaying. So why have a serviceability buffer of 3% as opposed to 2% or even less to make sure that our customers are actually just being assessed on that rate? Now, if we also have to add another filter into that and say, well, okay, guys, if someone owns one property already, let's create that buffer if you want to make it even sticks. And that means that let's create a filter just for first home owners to say that the serviceability buffer isn't 3%, it's at 1%, 1.5%, whatever percent. But so long as it's not really pushing them out of the game, and if it means that they can afford the loan, being a first home owner, at least it gets them in the property game, it gets them on board, and then their property, whatever they choose, can build equity, can build a bit of wealth. It doesn't mean that they've got to pay astronomical rent prices, stay continually chasing their tail trying to get a deposit. It means that they can actually get into the market easier. Now, is this bill going to pass? Let's hope so, especially for first home owners, because we can only see that if interest rates are going to start going down, which they look like they will be, we want to make sure that they are in front before. If interest rates are going down, it means property prices are going to go up, right? So the government really have to create this incentive of housing affordability by introducing new houses, not just talking about it, but introducing new houses and actually introducing things as micromanagement as what I'm talking about today with serviceability buffers, not just deposits, but also serviceability buffers, because we understand that our clients, even if they're first home owners 5 years ago, we're actually pressure testing the banks and we're fighting tooth and nail for our clients to refinance them every bloody year. We're doing a home loan health check and we're making sure, are they overpaying? And if they are, we're either negotiating with the bank to drop the rate right down and do a comparison, or we're swapping banks and making sure that our clients are paying the cheapest rate. It's pretty much the same as when you go to price match when you go to buy some electrical goods or whatever, and you go buy a computer and you see the same computer from one provider to another shop, you price match it, they drop their price, right? Why the hell can't we do that with the banks and make sure that if we're really fair income about people being able to afford property, especially first home owners, and get them in there, then why aren't we making it easier for them with little hacks such as serviceability buffers? I hope this all makes sense. Please contact me if the serviceability, if you want to know more about what serviceability buffers look like and how much you can borrow and all that sort of stuff. It isn't the most glorified subject, I understand, but it's a subject that we should understand as potential property buyers or property owners, to understand how the banks are going and how the governments could actually push on the banks to make these changes to make housing affordability even greater for the Aussies. Thanks again, and thank you for listening.